My name is Rahul Pal and I head the fixed income at Mahindra Mutual Fund. Lenin had once said, there are decades when nothing happens and there are weeks when decades happen. But the last 4 weeks of March 2020 was actually a period when decades happen in weeks. The volatility across asset classes was humongous, and the debt market wasn't immune to the volatility. In the latter half of the month, the domestic rates shot up, the corporate bond as well as the money market rates shot up by close to 200 basis points, putting extreme pressure on the rates. It required an RBI intervention in form of an advancement of the MPC meeting. The RBI cut the repo rates by 75 basis points, the reverse repo rates by 90 basis points. The CRR was cut by 1% for a period of 1 year. And of course, the RBI introduced also something called the TLTRO, targeted buying of corporate bonds and commercial papers by the scheduled commercial banks. So what do we expect going on from here? Well, we face a very difficult situation, a demand shock, a supply shock, and a risk aversion. There is liquidity in the system, but not much bias for risk on assets. Now that can be pretty scary. But what do we believe? The fact that within the GSEC and the corporate bonds, the GSECs predominantly depend on the Reserve Bank of India's intervention in the GSEC market. That is, should there be an increased fiscal deficit, the market clearly depends on RBI's helping hand or RBI's balance sheet to put a cap on on a rise of GSEC rates. The corporate bond markets would probably continue to have a bit of a high spreads till situations ease. The shorter end of the curve, we believe, will be quite benign because of the adequate and surplus liquidity in the system. So it's quite a safe zone to be in, the shorter end of the curve, because of the abundant liquidity now. I talk a bit about our scheme strategies. Mahindra Low Duration Bachat Yojana. We had an average maturity of close to 375 days, and we had a portfolio YTM of close 0.66.70. As we go ahead, we intend to reduce the average maturity of the scheme, but we believe the fact that this space may offer opportunities because of the abundant liquidity. Similarly, Mahindra Ultra Short Term Bachat Yojana, the average maturity was close to 187 days. Likewise, because it's on the shorter end of the curve, it provides ample opportunities because of the ample liquidity in the system. Mahindra Credit Risk Yojana, we are at a YTM of close to 9.20 with a modified duration of close to 2. There's a bit of a risk aversion sentiment. So while the credit spreads are quite high, for somebody who wants a risk on asset class allocation within the debt space, it looks good enough. For our debt strategies on Dhan Sanchay as well as hybrid equity, we think the debt allocation of a modified duration of 4 is good enough to navigate the next sometime in the next future, and we will probably reduce duration as we go ahead. So our message is we are much more comfortable in the shorter end of the curve, and thank you for watching us. Stay safe, stay healthy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.